So good afternoon, everyone, and welcome to Office Hours with Michael Kitces. Obviously, again, I'm not Michael Kitces, but today we're going to be taking a few moments to talk about how hybrid insurance producers, in other words, insurance producers who are also either RIAs or brokers, registered representatives, can preserve the QBI deduction, particularly if they're high income. Now, as a bit of background, last December, as you all know, the Congress, as well as the President, signed into law the Tax Cut and Jobs Act, ushering in really the biggest changes to the tax code we've seen in more than 3 decades. And while there were a lot of provisions baked in there, one of the very interesting provisions in there, especially from a business perspective, was the Section 199A QBI, or Qualified Business Income Tax Deduction. That's that 20% deduction that applies to pass-through income. Now, one of the key elements of that rule is that we need to separate specified service businesses, known as SSTBs for short, from non-specified service businesses. And the reason is that specified service businesses, once a person is high income, meaning they're over their particular threshold, for single filers, it's $157,500, and for married couples filing a joint return, it's $207,500. Excuse me, it's twice that, $315,000. I apologize. Married couples, $315,000, single filers, and actually, for that matter, all other filers, $157,500 of taxable income. Once you're above that and you're the owner of a specified service business, you begin to see your QBI deduction phased out, and then it's eliminated altogether in short order. Whereas if you are a non-specified service business, a non-SSTB, even if your income is above those markers, you can still get potentially the full QBI deduction. It just depends at that point on how much wages your business pays and or how much depreciable property your business owns. But the point here, the key point, is that whereas non-specified service businesses can continue to receive a QBI deduction for high-income individuals, specified service businesses, that deduction is gone no matter what once you exceed your phase-outs. So how does that relate to our business, right? How does that relate to the financial planning profession? Well, interestingly, the regulations that were put out by the IRS back in August really give us a better idea of what is a specified service business, which is essentially the kiss of death if you're high income, and what is a non-specified service business. And things like investment advisors, registered representatives, they actually even have job titles in there such as wealth planner, retirement advisor. All of those jobs are considered specified service businesses. So pretty much anything in the investment world is going to be a specified service business job, and obviously that's not good for individuals like us who are business owners and work in that capacity. However, interestingly, the regulations made very clear that insurance producers, insurance brokers, insurance agents are not conducting specified service businesses. And so that brings up an interesting question for advisors, many of them who have either RIA plus insurance businesses, or brokerage plus insurance businesses, or some that do all three together. Because if you do that, are you really running, let's say, one business where you're a financial advisor who happens to be compensated via commissions from insurance, commissions from brokerages, and registered investment advisory fees? Or are you running separate businesses? Are you running an investment advisory practice plus, let's say, a insurance brokerage or insurance agency? And that's a real question, whether you have one business with multiple lines in it, or do you have multiple businesses? Now, why is that so important? There are a couple of reasons. One of the first is the de minimis rule associated with this QBI deduction. And what that says is that if you run a single business with multiple lines, then that single business is considered a specified service business if more than 10% of the business income is from a specified service business. That's actually the number for businesses with revenues of less than $25 million, which frankly applies to most advisors out there. Again, that means that any advisor who is both insurance producer and a registered rep and or RIA, if they get more than 10% of their revenues, not profits, but their revenues from those investment-related activities, then the entire business is considered a specified service business. So you might have 89% of your revenue as an insurance producer and 11% of your revenue as a registered investment advisor or a broker, a securities broker. And that means that if you're operating that as a single business, the entire business is considered a specified service business. And if you're a high-income individual, which many advisors are, you will see that deduction, that QBI deduction, completely eliminated for all of your income. So a better way to go about this would be to potentially split out the businesses, to run multiple businesses and have one brokerage/RIA business and one insurance business. Now, this could be a little bit easier for some individuals than others. For instance, brokers in general, registered representatives, need to have commissions paid to them because you need to be a licensed entity or person in order to receive brokerage commissions. So unless you're literally going out and to create your own broker-dealer, which would be a licensed entity, you have to have those commissions paid to you as an individual. Similarly, most individuals have insurance commissions paid to them personally as a licensed agent. The only way to get around that would be to have your own licensed agency. Okay, so again, those revenue sources are generally paid to individuals directly as a person. You're going to be reporting that on your Schedule C. Whereas for registered investment advisors, generally, or a lot of the times, you'll see those fees paid to the actual advisory firm itself. And if you're the owner of the advisory firm, you can simply collect the revenue from there. So there are some practical elements here as to how your business is structured, whether you are a registered representative, whether you are a broker, and how you organize yourself in an insurance production capacity. Are you an agency, or are you the end agent who's going to report that on your Schedule C? Because imagine this from that perspective. Let's say you get all your income paid directly to you, and it's all Schedule C income. Does that mean that you're going to start filing multiple Schedule C businesses? You're going to have two Schedule Cs, one for your insurance revenue, or one for your insurance business, and one for your advisory business or your brokerage business. It's going to become very complicated. You're going to need separate books and records for each of those businesses. You'd have to file separate returns. Again, in the case of Schedule C businesses, it might just mean two Schedule Cs, but if we're talking about entities, it might mean two entity returns. That might add more cost. What about actual cost accounting measures that would have to be taken into consideration? For instance, do you split office space? And how much of that office space do you allocate to your insurance business versus to your brokerage or RIA business? Or do you have staff? Do you have staff that's completely dedicated to just the insurance business? Do you have staff that's completely dedicated to just your securities business? Or do you have staff, more likely, that is doing both? In that case, again, how are you going to separate the expenses that are attributable to each of those businesses? It becomes a very challenging situation. You're going to have multiple W-2s paid from different entities. Again, more complication here. And of course, from a tax perspective, there's going to be an incentive here, right? The incentive is going to be to try to throw all the expenses you possibly can into the business that is the the specified service business, right? We want to get all the expenses into the specified service business and have as much profit as possible from the non-specified service business, because if you're high income, it's the only business that is potentially going to be eligible to receive that 199A QBI deduction. So will that raise flags with the IRS? It certainly would for me, right? If I saw multiple business returns, or especially multiple Schedule Cs, could that become an audit risk for people? We just don't know yet, because we haven't even filed a single one of these returns yet. And at the end of the day, you have to ask, with all this additional complication and potential audit risk, would splitting businesses out like this even be worth it? Would it even be worth it? For instance, let's say you separated your insurance business from your brokerage business and your RIA business, and that insurance business at the end of the day produced $200,000 of net profit. Well, that could get you a deduction of potentially 20% of that amount, or $40,000. If you're at a 40% combined federal and state tax bracket, that means your net actual value to you in terms of dollars becomes $16,000. 40% of the $40,000 deduction, right? So at $16,000, how much time and effort did it take? How much additional cost did it take you in terms of your time? How about your staff in terms of their time, in terms of accounting for things separately, paying your accountant for multiple returns? Is it possible? Yes. But unless you have a lot of revenue coming in from your insurance practice, it very well may not be worth all the extra work it takes to do it. So that's all the time we have today for Office Hours with Michael Kitces. Again, obviously, I'm not Michael Kitces, but if you have questions, email them to us at questions@kitces.com. Follow us at Michael Kitces or at CPA Planner. And we're looking forward to seeing you for our next Office Hours real soon. Take care, everyone, and have a great day.